This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading the open. While the open of the trading day begins with the Asian session and the time is exact, the time of the open for the European and American sessions are not exact because there's some overlap with the financial market. The high or low of the session typically occurs early in the session. Here's a collection of 5-minute charts of the euro versus the dollar. The open of the session is not exact, and it does not have to be the same every day. For example, here's the start of the European session, and it began early, around 10:15 Pacific time. But on another day, the open of the session began at 12:15 a.m. Pacific time, 2 hours after the start of this day. Even though it looks like it's before, I don't have the charts aligned perfectly for time, but this is at 10:15 p.m., and this start of the session is at 12:15 a.m. Here's the U.S. session. The first significant move of the day began at 5:10 a.m. Typically, there's some kind of a breakout up or down around 5:10, 5:15, or 5:30 a.m. Pacific time. That's usually when traders consider the day beginning or the session beginning. I'm looking for consecutive bear bars or consecutive bull bars with decent-sized bodies. Usually you get 2 or 3 decent bars, and for me, if it's in that window when I'm expecting the session to start, I start trading it actively because I feel like the session has begun, and it usually is the start of a session. On this particular day, we got 3 bull bars here, not much happening until 6:35 Pacific time, and then the market started to enter a trend. Looking for at least 2 or 3 decent-sized trend bars in either direction. Here we had 3 bear bars, here we had 3 bull bars, and this led to a swing up, that led to a swing down. This is the first trade of the day. This is the first trade of this day. Asian session on this chart began at 4:05 p.m. We have a pair of decent bear bars. After a tight channel with a lot of very small bars, the bars are getting bigger. This is the start of when traders are beginning to trade. On this particular day, the day was very quiet until 5:20 p.m., more than an hour after the start of this day. They look for big bars in the time window when they're looking for the start of the session. There are 3 sessions a day, and I talk about the open of each session. When I'm talking about the open, I'm talking about a window of time when the market begins to have a first swing up or down. Traders are looking for some sign that the market is beginning to move. It's fairly common for the market to have an opening range, an early trading range, and sometimes it'll last an hour or 2 before there's a breakout. Here, the market went sideways and went down and went up and went down and went up and went down, and then we got a more sustained breakout after a couple of hours of trading range trading. Sometimes traders wait for a breakout one way or the other, and it just never comes. The day remains a small trading range day. On the other hand, sometimes there's a huge breakout on the open instead of an opening trading range. So instead of this, sometimes the market immediately begins to trade at the beginning of the session. Here's another example. 3 consecutive bull bars at the start of the session. The market went straight up without much of a sideways market, a little bit of sideways here. I want to make a point, I'll talk more about it later. No matter how strong you see a move on the open of any session, there's a 50% chance it'll reverse. 50% chance in this case that this is a test of some resistance level. I don't have resistance levels drawn in, but 50% chance it's simply a buy vacuum test of resistance, and the market decides that it's going in the wrong direction, and then it reverses. Here we have a strong sell-off, and there was some trend resumption as the session continued. Very often, it's not clear when the opening range has ended until an hour or two later. Now, why are traders interested in trading the open? Because it's the highest probability time of the session to find a swing trade. Financial institutions are opening, governments are opening, and news comes out, and it often results in a swing up or down. For example, here, traders would look to buy above the high of this bull bar or on the close of the second or third bar, looking for a swing up. We have a parabolic wedge, a tight bull channel with 3 pushes, 1 pullback, 2 pullback, 3. Traders will look for a swing down. Very tight channel. A lot of bulls will take profits here. They should. And many bears will short. Other bears will wait until there's a strong breakout to the downside and then start to short. Tight bull channels usually have to go sideways for 10 or 20 bars before the bears can take control. When you get a parabolic wedge, there's only a 40% chance of a reversal into a big bear trend, and therefore a lot of traders do not sell initially. They wait for the breakout. We reverse down, and then we reverse down a second time, both with decent bear bars closing on their lows. This is a reasonable sell at the start of the session. Now we're getting a double bottom after the double top. Reasonable to take profits on your shorts. Aggressive bulls might buy, but it's a pretty weak buy signal bar, simply a doji, after 2 good bear bars and a strong initial sell-off. Here we have 3 bull bars. The bears tried to sell off, and the bear breakout to a new low failed. And now we have a 4th bull bar. All the bull bars have decent-sized bodies. This one's closing on its high, plenty of room to the moving average. It's a reasonable buy. It's a type of double bottom where the second bottom is a lower low. You would either exit below this bar because of a double top, or you would exit below a bear bar closing below its midpoint, like this bar, and you get out here. And bears would sell, looking for possibly a swing down, a double top at the moving average, and then a micro double top and a bear bar closing below its midpoint. We rallied again, we rallied a third time. We're in a tight trading range, a sideways market. We have a higher low and a lower high. This is a triangle. If you want, you could simply call it a trading range, and you could call this another test of the moving average with a very good bear bar. You can sell it as a test of the moving average, a double top bear flag with this high, or a triangle. Market is well above the moving average, and we have 2 or 3 legs down to the moving average. We sold off, we rallied. We sold off, we bounced a little bit, and we're selling off a third time near the moving average with a decent bull bar, a second decent bull bar, reasonable to buy. This as a wedge bull flag. We have a micro double top here and a double top here, so it's a double top lower high. Reasonable to get out of longs below this bear bar, especially since it's the second sell signal bar closing on its low. We rallied a second time. We're far below the moving average. We have a bear bar closing on its low. We have another bear bar here, so decent selling pressure. Reasonable to go short on a stop below the low of that bar. Strong sell-off. And then we have higher lows, lower highs. It's a triangle. Even though it's a bear bar, it's a possible reversal. Chances are minor, a lot of bear bars in here, but it is reasonable to get out of shorts above the high of that bear bar because of a triangle late in a bear trend. Three attempts to reverse up. One had 2 legs up, and then one pulled back 2. This is the second attempt to reverse up, and this is the third attempt to reverse up here or here. reasonable to take profits. We have a small double bottom here, bull bar closing on its high. And it's also a nested wedge. We have a reversal up, a second reversal up, and now this is the third reversal up. Reasonable to get out of shorts above that bull bar, and bulls, in fact, would take this buy. We have a lot of good bull bars here, here, here. We have a pretty clear wedge here inside of a larger wedge. I mentioned earlier that no matter how strong a rally or a sell-off is at the start of a session, 50% chance it's going to fail and reverse. That strong sell-off is a test of support. This strong rally is a test of resistance. Again, I don't have all the bars to the left drawn in to show what constitutes resistance here or support here, but you can assume that whenever you see a very strong move on the open of a session, 50% chance it's going to reverse. Strong sell-off on the open of the European session became the low of the session. Strong rally on the open of the US session became the high of the session. This was clearly a buy vacuum test of this lower high. We have a spike down, a tight channel, and then a broader channel down. So it's basically a type of spike pullback channel. The market typically tries to test the top of the channel and evolve into a trading range. And because a trading range is possible, you always have to be thinking about a possible second leg trap. First leg pullback, and then very, very strong second leg traps traders into buying high, and then reverses. Everybody should be aware that when a session opens, or when any market opens, 80% of the time there is at least a minor reversal in the first hour, the first 90 minutes. For example, here we rallied, sold off, and formed a double bottom, and bull trend resumed. Here we sold off and rallied, and we had a wedge bear flag. Traders should be constantly looking for reversals, and the reversals typically come from either wedges, wedge tops, wedge bottoms, or double tops, double bottoms. This is an example of a double bottom, and this is an example of a wedge bear flag. %80 of the time, no matter how strong a rally you have on the open, or no matter how strong a sell-off you'll have on the open, expect at least a minor reversal. A minor reversal is a leg lasting 5 to 10 bars. Traders will look for a reversal back up. Here we have a 4-bar sell-off, and if they see bull bars starting to close near their highs, the bulls will buy, looking for a resumption of the original trend. So bull trend, sell-off to a double bottom, here a slightly higher low double bottom, and the reversal down. Even though it looked strong, it was minor. Strong sell-off on the open, and we have 3 pushes up. Bull bar, bear, couple bull bars, bears, bull bars, 3 pushes up. Instead of a reversal up, this rally was a minor reversal up in a bear trend, and it became a bear flag. Here we have a very strong open, very strong rally, but no matter how strong the rally or sell-off on the open is, 50% of the time you'll get a major reversal into an opposite swing. Bears will look to sell below bear bars closing on their lows, hoping that they get a swing down. You cannot see bull and bear bodies on this chart, but I wanted to show the entire session, so I had to compress the bars together, and that made it impossible to distinguish bull and bear bodies. Here, a very strong sell-off on the open, and you might think that it's going to be a bear trend, but remember, no matter how strong a move is on the open, 50% of the time it's going to reverse into a major opposite trend. Traders have to be looking to buy above bull bars closing near their highs. You don't take every trade, but you look to take at least one. On the open, you're looking for double tops, double bottoms, wedge tops, wedge bottoms. Here's an example of a very quiet open, but we have a double top. Traders should look to sell below bear bars closing near their lows. You can see we had a rally on the open that tested an earlier high. Bears will look to sell below bear bars closing on their lows, possibly for a swing down, and they got that here. Here we have a rally, and we have two more legs up, but then a reversal. Traders will look to sell below bear bars closing on their lows, hoping to get a swing down, and here we had a swing down lasting several hours. Again, you don't take every sell, but you should try to catch at least one, hoping for a swing down. Double bottom, look for a reversal up, buy above bull bars closing on their highs. It turned out the four bear bars formed a sell climax test of this low, and they could not get below that low, so it's a higher low double bottom. Bulls will buy above bull bars closing on their highs. And finally, we have a wedge bottom. We have a strong sell-off, we have a second leg, and then a third leg. You have to be prepared for a reversal. Bulls will look to buy above bull bars closing on their highs. So here we have an example of a double top. Here we have an example of a double bottom. Here we have an example of a wedge top. Here we have an example of a wedge bottom. When a session opens, you should always be looking for these things. 80% of the time, you'll get at least a minor reversal. 50% of the time, you will get a major reversal. Each of the three sessions usually tries to create an early high or low of the session. 5-minute chart of the euro versus the dollar. At the close of any bar in any session, what's the chance that we've already seen the high or low of that session? Here's 5:30 a.m. Pacific time. This is the start of the U.S. session, and we have a big bear bar. That's how we know it's the start of the session. It's in the window when the market often breaks out, and here the bears have a breakout. The first bar of the session has a 20% chance of remaining the high for the remainder of the session, and a 20% chance of being the low of the session. This is a strong bear bar closing on its low, probably going at least a little bit lower. By the end of the seventh bar, the market has a 50% chance that it has already seen either the high or low of the session. By the close of this bar, the seventh bar of the session, 50% chance this will remain the high, 50% chance this will remain the low. By the close of the first hour, bar 12, there's a 70% chance that the session has already made its high or its low. This is the 12th bar of the session, and therefore there's a 70% chance either this will remain the low of the session or this will remain the high of the session. By the close of the 18th bar, which today is right here, there's a 90% chance that the session has made either its high or low. This bar's high is right around that high, maybe a little bit higher. So at the close of this bar, 90% chance this will remain the high of the day, or this will remain the low of the day. I'm saying the day, I mean the session. There's nothing magical about 18 bars. It's an hour and a half. If I said 15 bars instead of 18 bars, it would be slightly less than 90%. If I said 25 bars instead of 18 bars, the probability that the market has already seen its high or low of the session would be greater than 90%. What traders are looking for is a time in the session when the probability is high that the market has made either its high or low. Here, we broke above the 18-bar range. We know there's a 90% chance that it's not going to a new low, and therefore traders will buy reversals down, betting that a trading range is much more likely than the start of a bear trend. strong sell-off, probably simply either a bull flag and higher prices, or a trading range. If it's a trading range, traders can buy for any reason and buy more lower, stop below the low of the day, betting that if it's a trading range, it'll come back up to the high of the range. By the close of the 80th bar of the session, there's almost 100% chance that the market has either made the high of the day or the low of the day, the high of the session or the low of the session. However, as a trader, that does not help you, because if you've been trading for 80 bars, it's time to stop trading, and usually the session is over and the market is going to start to get very quiet. There's a 90% chance of a profitable swing trade early in the session. The first bar has a 20% chance of being the low of the session or the high of the session, or at least the high or low of the next several hours. Here, the first bar of the session was the low for the next 60 bars, next 5 hours or so, and there was a swing up above the high of the first bar. The first bar of the session here was the high for the remainder of the session. We tried to go above it here, and we tried to go above it here. Both times failed. The first bar here, even though it did not lead to a swing down, remained the high for the next 40 bars. In this video, I want to talk about focusing on finding a swing trade on the open of the session. I have lots of other examples in the videos on swing trading and on scalping. In the United States, there's often a report at 7 o'clock Pacific time. When I started trading over 30 years ago, those reports often led to huge reversals up and down. And now, the institutions are very good at anticipating what the results of any report will be. You usually do not get much of a move after a 7 o'clock report. First 10 bars of the session, 50% chance that the market has already made the high or low of the session, and certainly the high or low for the next several hours. Here's the 7th bar of the session. We have a reversal down below the moving average. This remained the high of the session. It never went above that high for the remainder of the day. First 90 minutes, the first 18 bars on the 5-minute chart, 90% chance that the market has already made its high or low. And I'll talk more about this in later videos on trading the open. Parabolic wedge rally, it became the high of the session within the first 90 minutes of the session. High of the session here, also within the first 90 minutes. A double top below the moving average. A similar thing, a double top below the moving average, decent bear bar. Here is a series of 6 charts, and this is the daily chart, and this is a 15-minute chart, and it's the euro versus the dollar. A white body is a bull trend day on the daily chart, and a dark blue solid body is a bear trend day on the daily chart. The point I want to make is that you can see on this bull trend day on the daily chart, there's a tail on the bottom. 90% of the time, that tail on the bottom is caused by an early sell-off. Here's the open of the day, and there's the low of the day, and then the market reversed up. The distance between the open and the low is this tail on the bottom of the chart. At the end of the day, there was some profit taking. Here's the high of the day, here's the close of the day, and that little profit taking at the end of the day caused that tail. The point that I want to make is that when you have a bull trend day, usually there's a tail on the bottom of the bar on the daily chart, and that tail is usually caused by an early sell-off that reverses up. 10% of the time, if you have a bull trend day on the daily chart, that tail is not caused by an early reversal up. It's caused by a later reversal up. You can see here the reversal came in the final hour of the 24-hour trading day. But 90% of the time, if you see a tail on the bottom of the daily chart, it's caused by a reversal that takes place fairly early in the day, the 24-hour day. That day begins with the Asian session. Here's a doji bar, a bar with a small body. It could be a small bull body, it could be a small bear body. We have a tail on top, which means the market went up and reversed down. We have a tail on the bottom. That means it went down and it reversed up. Looking at the daily chart, it's impossible to know which reversal came first. In this particular case, it went up and reversed down, creating that upper tail, and then it went down and it reversed up, creating the lower tail. Here's a bear trend day on the daily chart, and you know 90% of the time that tail on top was caused by an early rally that reversed down. Here's the open of the day. The day opens with the Asian session, and it rallied on the open and then sold off for the remainder of the day. "90% of the time, when you have a tail on the bottom of a bear trend day, it's due to a small reversal at the end of the day, usually due to some profit taking. Although you cannot see here, the close is above the low of the day, and that's what created that tail at the end of the day. Bear trend day, and we have a tail on top. 10% of the time, that tail comes from a reversal later in the day instead of on the open. 90% of the time, the reversal down occurs fairly early. 10% of the time, it occurs later. Sometimes it occurs very late in the final hour. I began by talking about how the session time is not exact. There are 3 sessions a day. Traders begin trading once there is a strong breakout up or down. A strong breakout can be one big trend bar, or it could be 2 or 3 medium-sized trend bars. And once the traders see that, they believe that the trading has begun. Most of the time, the high of the session or the low of the session occurs early in the session, and therefore traders should be always ready for some kind of a breakout early in the day, early in the session, or some kind of a reversal. If there is a strong breakout up or down early in the session, 50% chance it'll be a trap and it will reverse. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading the open.